Hi guys, welcome to lesson 9 of the Trading 101 course. In this lesson I'm going to be talking about market orders, limit orders and stop losses. Let's get straight into it. Hi guys, it's Enny, aka the Nock Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, hit that subscribe button, and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram at the Nock Trader on all social media platforms. And if you check the description section below, you'll see a link to my mailing list and my Discord chat room. Now, if you haven't seen lessons 1 to 8 before watching this, I advise you go and watch them in order from 1 to 8 and then watch this afterwards because it'll make more sense. And in this lesson, I'm going to be talking about market orders, limit orders, and stop losses. So these are all the different types of ways you can enter a trade. Let's get straight into it. So there's 3 main ways of taking a trade in the stock markets through your trading platform. There's market orders, limit orders, and then stop loss orders. And even within stop loss orders, there's different types of stop loss. There's a trailing stop loss and a guaranteed stop loss, and I'm going to go through all 3 of these type of orders in the next couple of slides. So a market order is an order to buy or sell a stock at the current buy, bid, or sell ask price. So a buy or a bid price is the same thing. You can either hear the terms are interchangeable, buy or bid. It just depends on the trading platform that you're using. IG, which is a trading platform I use the words buy and sell rather than bid and ask, but it's all the same thing. Now, in the example below, FTSE 100's price is 7509.1, so that's the current price at the time that I took that screenshot. Now, the 4 in the middle is the spread. So the spread is the difference between the buy and the sell price. So if I was to buy FTSE, it'll be 2 points above the current price, and if I was to sell, it'll be 2 points below. So the reason why there's a 2-point discrepancy either direction is because that difference between the current price and the price that you want to buy, or the current price you want to sell, is where the trading platform kind of take their cuts. So the spread can differentiate depending on the asset class or the volatility of the actual stock, but in this current situation it's 4. So straight away, the 2 that they take away from whatever trade you take is what the trading platform take as kind of their cut. And just to reiterate, the market order is all about just buying or selling at the current price. Obviously, you take into consideration the spread as well, but it's whatever the current price is. Hi guys, I'm logged into my IGA demo account to show you how to execute a market order. So I'm currently using Bitcoin as my example for how to execute a market order, because I'm currently filming on a weekend, and the cryptocurrency market is the only asset classes right now that are live. So let's get straight into it. So in this example, I'm going to take a long position. So I'm going to buy. So I have to click deal here. It's already on deal, luckily enough. I click buy because I want to take a long position on Bitcoin. I pick my position size. So in this situation, I'm going to just keep it at 1. So it's £1 per point movement. Every 1 point it goes up, I make £1. And then it'll show you your margin requirement. So here I need £5,011.54 in my account to take this trade. I've got that in my account. Well, this is a demo account anyway, so I've got that. So that's fine. I can take the trade. And then all you do is place the order. So obviously the order is going to be placed at the current market price. So I'm down £36 straight away, and that's obvious because, as you can see here, the spread is 36. So what that denotes is that the difference between my buy price and my sell price is 36 pips. So I need to make up for 36 pips before I can break even, and that's kind of what the trading platform takes. That's kind of like their commission. So if I was to sell my sell out my position, it'll be at this price here. So whenever you take a long position and a short position, you have to take into consideration that the spread, because even though the current price is this, whatever this is here, the buy would, in this case, would be 18 pips above that, and the sell would be 18 pips below that, and that's what gives you the 36 pip spread. And then you have a limit order. So a limit order is an order to buy or sell a security at a specific price or better. So the key thing that you have to take into consideration here is about buying at a specific price or better. So if you want to do a buy limit, you can either set it for a price a little bit lower than the current price is, because you want to get a better position so that if it hits it, you can be in a better position to go long, and vice versa for the sell limit. I hope that kind of makes sense. So what that means is that if you want to, let me use an analogy. If you want to buy an apple and it's 50p, you can either offer to buy it for 40p, for 45p, for 49p, and if you buy it for 50p, then that's a market order because you're buying at the current price. So whatever price you offer below the current price, if the person that's selling it to you accepts that offer, you can consider that a buy limit, because they've accepted your price at a lower price than the current price. But you have to take into consideration that a limit order is not guaranteed. So the same way that you can haggle for an apple to buy it under the current price, the person that's selling to you can say no. So if it doesn't hit that that price that you set the buy limit at, then it won't be executed. And then the same works vice versa for the sell limit. So in this example of how to set a limit order execution, I'm going to show you how I'm going to take a long position on Bitcoin, but a limit order long position. So obviously, as I explained before in the previous slide, you want to take a position better than the current price, not at the current price, because if you take at the current price, that's just a market order. So if I was to take a long position on Bitcoin, it would have to be at a price lower than the current price, because you want to maximize your profit, and the best way to do that is to take a long position at a lower price than the current market price. So for this example, if I want to go long Bitcoin, I'll click buy, set my price, set my position size. So in this case, I want to do 50p. I'll do 50p per pound. So every 1 point Bitcoin moves, I make 50p, and I'll set the price level so this lets you know at what price level you want the limit order to be executed. So I'm going to put 9900. So that means it needs to drop 94 points at its current price to execute my limit order. Remember, limit order, there's no there's no guarantee that it's going to get executed, because if the price doesn't hit that point, then the order will never get executed. So now that I've set my price level and set my position size and clicked buy, I have to check the margin requirement. Yeah, I've got enough money in my account. It says I need £2,475 in my account to place this order. If I didn't have enough in my account, this would go red anyway. So I have enough to take a position in my account. I'll just press limit order, and there you go. So the order has been placed, but that doesn't mean the order has been executed. Price now needs to hit that execution price of 9900, and then my order should be executed. But if you go over here, you'll see that the order has been placed and it's just waiting to be executed. And last but definitely not least is the stop loss order. I just call it a stop loss. I don't use the term order at the end of most of them. It is an order placed with a broker to buy or sell. It is an order placed with a broker to buy or sell once the stock reaches a certain price. So stop loss limit is. So last but definitely not least is a stop loss order. It is an order to play. So last but definitely not least is a stop loss order. It's an order placed with a broker to buy or sell once the stock reaches a certain price. A stop loss is designed to limit an investor's loss or lock in profits on a position. So in this video, I've taken a long position with Bitcoin at £1 per point movement at a market order price. Now, to prevent making too much loss if the trade goes against me and price starts falling, I can set a stop loss. The quickest way to do this is to click this dotted line here where the market order has been placed and just drag it down. Now this grayed area is an exclusion zone. You cannot set your stop loss there because it's too close to the market price. As you can see here, it says minimum stop distance is 30 points. So you can only set your stop loss as close as 30 points away from the current price or the market order price. So if I want to set my stop loss for 9900, I could just drag it down to about here. So it's close enough. It's not exactly there, but that's close enough. And it will show me my how many pips away the price is from the stop loss is from the market order price, and how much I stand to lose if my stop loss is triggered. So I'll lose £115.17 if my stop loss is triggered. But this is a good way of managing your risk if you're taking a trade. Now remember that you can do this. The same thing works, but the other way around if you're taking a short position. If I was taking a short position, your stop loss would be by dragging the cursor above the current price, because obviously you would be making profits if price went down. Now this is just a normal stop loss. There's also a guaranteed stop loss, and you can do different types of stop loss. You've got guaranteed stop losses, and then you've got a trailing stop loss. Trailing stop loss is when you set your stop loss a certain amount of pips away from your current price, and what that does is that as price moves, the stop loss will move with it, because it wants to maintain that distance away from the market order price. And the guaranteed stop loss is just a normal stop loss, but you pay a slight extra premium so that if the stock gaps down or anything crazy happens overnight when you're taking a position and you're holding it overnight, or then it will be triggered regardless.